Assalamu alaikum friends, welcome to lecture 35 of SBL. Today's topic is project management and this is the last lecture in your SBL. So in total there are 35 lectures, and if you have not watched my previous lecture, you can go to the playlist of SBL, or you can click the I button that will appear on top of your screen on the right hand side and get to the playlist. Or even at the end of my video you can click on the playlist box and it will take you to my SBL playlist. Okay, and this lecture is going to be pretty lengthy, and from the point of your SBL exam, project management is it's a very good question that you can expect. Questions frequently comes on project management in SBL. Okay, so let's start. Here we are going to focus on the stages of project. What do you start, what do you do, and then how do you end? First, we start with project initiation. We start building a business case, why a project is needed, what are the benefits, what are the costs. Second, we make a plan. Then we execute the plan. Then we monitor and control. Then we complete. So these are the steps or stages in project management, and each stage you need to know a lot of techniques or models. Okay. In your SBL exam, you could be asked at any stage. Maybe you might be asked question on project completion, not on other stages. Maybe it's just on the business case. Maybe it is just on the monitoring and control. How do you monitor and control a project? So it could be anything. They will not ask you all the 5 stages. Okay. Now, so project management, this is the sequence that they follow. You always start with a business case. Why? Because project is a long-term investment. It is long-term investment. It requires a huge investment. Finance is needed. So before going for it, you have to have a business case. It's like when you go in a bank for a loan, you often have to prepare a business case for the to the bank, right? Why you need a loan and all. And if the bank feels that your business case justifies why you need a loan, they will give you the loan. Otherwise, they will reject. Same for the project management. Okay, project means it could be any project. Maybe you have a project to construct a building. Maybe you have a project in a pharmaceutical company for the drug medicine. It could be any project management. Okay, this could be applied for any project that you have. Then after the business case is done, next comes the plan. We start planning. Then we execute that plan, then we control that plan, and then we complete. Because once you start, it needs to come to the completion stage. After that, project ends. Okay, so what is a project? How will you understand that it's a project or not? These are the features. Okay, in your SBL exam, if they have not mentioned that is a project or a project management, look for this feature, whether these features are present or not. If it's there, it's a project. For example, it will have a specific objective. Whenever you decide to do something, launch a campaign or construct a building, it has an objective, right? Second, it will have a time scale. It will have an end and a start date will be there. Then it consumes resources. People will be needed, time will be needed, finance will be needed. It's unique. Remember, even from the three things, if you are not able to differentiate, at least the last point will be enough that it's unique, because no two projects are same. Okay, it's a one-time project. You will never get the same project again, because projects are customized for the user, for your customer. It is always customized. It is not a standard thing. Then cost constraints are there. You have some cost constraint. So this has to be clearly defined and understood from the beginning of the project, so that your project remains viable. These are some project features. Now, in your SBL exam, they will not ask questions directly, what are the project features? No, 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 no. The reason why you have to go through is for you to identify in the exam whether it's a project or not, by if they have this feature. Okay. Then it requires organization. It needs organization. It needs a team. It needs people to finance. Okay, because I told you project is for a long term. It's a long term investment, and it takes a long time to complete also. It is not operation that you can complete in one day, or it's not a daily thing. It requires 5 6 years. We don't know the time period. It varies, but it's a long time period, more than 12 months. Now, starting with our first stage, that is we initiate or you can say project initiation. We start the project by having a business case. Why do you need a business case? Number one, to obtain the funding. Remember, someone has to fund the project. To obtain that funding, you have to convince them why your project is worthwhile. Why do you think your project can achieve? And how are you going to tell them? Verbally? No, you have to make a business case already, giving them the advantages or the risk, why the project has to go ahead. Why do you think? Second, you have to compete with other projects. If you're in the government sector, let's say you have a project to build a road or some infrastructure. It's not only you who is coming there. There are many other who are there. Contractors are there. You have to compete with them. So you have to have a strong business case. Third, improve planning. Having a strong business case will help you in planning also. Improve project management. Your project, you can manage it better. Now, important for your SBL is this one. This has been asked. I think it was asked in a specimen 2. I don't remember the past paper, but please do go and check which paper they have asked. It is known as PID, Project Initiation Document. It is not at this stage, later stage maybe, but it has been asked. The contents has been asked. So what is the content of a business case? Currently, what is your strategic position? You have to start with it. This has to be there in your business case. What is your strategic position? Are you cost leader? Are you what? Second, constraints. What are the constraints, limitations of the project? Third, what are the risks and how are you going to manage this risk? What are the benefit and the cost of this project? And how are you going to manage it? Now, the formal business case document. Every business case document starts with an introduction. You have to have this. Okay? Introduction means it sets a scene or the reasons why the project has been considered. Second, executive summary. This is like the summary of your whole document. By reading few lines from that executive summary, you will understand what the whole document talks about. Okay? If someone does not want to read the whole document, at least by reading executive summary, they should have an idea of the whole report. Okay? And mostly, this is read by the senior management team, this executive summary. It includes what are the key considerations, what are the options that are considered, what are the reasons behind any recommendation that is made, and if there are any key numbers, summary of those key numbers are put in this executive summary. For example, an output from a financial project appraisal, maybe the net present value of the project, or maybe any method financial project appraisal that you have done, the numbers and all you can put in executive summary. Third, description of the current situation. You can do a SWOT analysis here to identify your strengths, weakness, opportunities, and threats. Okay. Then, what are the options considered? Remember, there is not just one way out. There may be so many other options that you have considered. What are those? Assess each option. And why did you reject some and accepted the one which you accepted? You have to give reasons. Then, cost and benefit. Obviously, you have to give an analysis of cost and benefit. Okay, and remember, when you're giving cost and benefit, mostly it is in terms of numbers. So this you can give it as an appendix at the end of the document. How you got the value, how you calculated. Maybe the key figures only you can put it under the main document. But the workings and all could go under appendices. Okay. But it does not mean that it's only numbers. Okay, benefit and cost could be intangible also. Like customer satisfaction or what is the staff morale because of this project. Things like that also. Impact assessment. What is the impact? For example, impact on the management style, on the staff role, on the culture can be provided. Risk assessment, the risk of this project. What are the risks and how you're going to manage the risk? What are the contingency plan you have if things go wrong? Right? Recommendation. What do you recommend? That means basically in this section, you are going to pull out a lot from other sections of the business case together in this area. And appendices. All your detailed cost and benefits are here. Okay. Now we are going to go through the strengths, weakness, opportunities, and threats of a project. Strength means things that are going well in the project, skills that are prized, major successes, parts of the project that are well received by the user, or maybe you have completed earlier than the due time. Weaknesses means things that are going bad in a project, skills that you are lacking, major failures, and part that did not go so well with the user, or maybe you have completed the project late. Coming to the opportunities could be maybe some changes in the outside, which is giving an opportunity for your project, right? For which you can exploit your you can take advantage of the project. Things that are likely to go well in the future. See, opportunities or threats are about future, okay? External impact. Then coming to threat, opposite of the opportunities. It is going to, you have to defend yourself against this and things that are likely to go bad in the future. Now, earlier I told that there are project constraints, some limitations. There are three main limitations of a project. They are cost, time, scope. Whenever you are coming with a project, you have a budget. Within the cost you have to make. If you are going above that cost, okay, it is not good. Time, you have to complete in a specified time. If you are taking longer than that, it could have a negative impact. And scope of the project, the extent of the project. So starting with cost, every project will have some initial budget, okay? So your job is to make sure that you stick to it. So you need to prove the benefits of the project exist the cost. For time, it has an overall time also on when you have to complete the project. So here you have a time budget. How much of man hours are you using? How much of them are available for the project? For the scope, what are the series of tasks that needs to be performed? And the quality level that is expected of each task. Okay, remember this three project constraint. In your exam, it could be anything. Or maybe one or two, or maybe it's affecting all the three. Okay, now coming to the risk part. Basically, we are going through in detail of the business case only, what I've explained you later, before. So now risk. Say risk analysis has three key elements. Number one, identifying risk. Number two, assess that risk. Number three, manage that risk. Identifying risk could be done, okay, with the following: cost overrun. When you are overrunning the cost, you are going beyond that plan. That means you have planned or you have a budget of 1 million, you are spending 1.5 or 1.2 million. That's a risk. Second, missed deadline. If you're missing the deadline, time constraint, it's a risk. Poor quality, scoop, it's a risk. Disappointed customers, it's a risk. Business disruption. So all this will help you. If all these are present, that means there's a risk. Now, it can result in 4 types of consequences. What is it? If you're having a risk, your benefits are delayed or reduced. Your time frames needs to be now extended. Now you need more time. Your outlays are advanced or increased, and output is reduced. Output quality is reduced. These are the consequences, negative consequences of risk. So now how do you assess risk? You can assess risk based on two axes. We know this from our SBL and also from our earlier studies. One is based on likelihood, the other one is impact. What is the impact of the risk and what is the likelihood of that to occur? And how do you manage risk? This. You know the TARA model, right? Managing risk. Earlier in a risk section of our SBL syllabus, we went through risk. How do you manage risk? We either accept risk, we either reduce risk, we either transfer risk, we either avoid risk based on this matrix. I hope you remember this, right? You didn't forget it. Well, now let us do a question on this before we move with the benefit of the project. Just now I've realized that before we do a question, we have to go through this table. Okay, so starting with the risk. Let's say the risk is you are not able to recruit qualified staff. What is the likelihood of this happening? Low. Because there's very less chance that you are not able to recruit quality staff in project management. Impact of his medium. So what are the mitigating actions? You ensure the remuneration is appropriate to the skill level. Make sure. Okay. What are the warning signs? How do you know that this risk is there? Look at the number. If the numbers are low, okay, the low numbers and the poorly qualified applicants, if this is there, it's a warning sign. This will tell you what you need to do. Coming to the second risk, retention of staff. Maybe you're not able to retain your staff as a risk. What is the likelihood of this medium? Impact this medium. Mitigating actions could be you could motivate them through some good contractual terms, good job design, or improve their working environment, involve them in some personal development, right? You can even give a clause also in your contract that you are going to retain some of the key stuff. They needs to be retained, okay? Retention clause. Warning signs is if you can see that there's a low morale and high turnover, will tell you that it's hard to retain staff. Next, we have necessary premises not available. We know that in a project we need premises. So likelihood of its medium and impact is very high. What are the mitigating actions? Accommodation available to project is currently limited. Okay, so because of this, there could be implications for the future of project if additional functionality is required and appropriate accommodation is not available to support it. Maybe you need available accommodation, but currently it is not possible just to increase accommodation, right? But you have to make sure that you work on this issue. What are the warning signs? Because of this, there are delays to work, okay, because you don't have the facilities. So make sure that you have the facilities, even if it takes longer time. This type of risk usually takes a longer time to settle. Then we have failure to get all parties to come to one purpose. Because in a project, it always works on a team. No individual person can work on a project. It's always a team. Okay. Likelihood is low. Impact is very high. Mitigating actions could be you could define what are the stakeholder needs. You could have a clear plan with the well-defined deliverables. Okay. You can even use a sound project management methodology. All these things could be used. Warning signs is when you can see that there are differing views on the plan. And also messages are confused in your draft publications. Okay. So now let us do a question. Test your understanding 1. So here you have to suggest how those 4 risks could be best managed. Okay. And the professional case is evaluation. A leisure company has approved a large-scale investment project for the development of new sports center and grounds in a major city. The forecast net present value is 6 million, assuming 5 years steady growth in business and a constant return. A number of specific risks has been identified. First, a potential lawsuit may be brought for death or injury of a member of the public using the equipment. No such event has ever occurred in the company's other center. So we'll go one by one rather than reading all the risk. How are you going to deal with the first one? Tell me. The lawsuit. See, when you have to manage the risk, you have to see whether likelihood and the impact. The likelihood of this happening is high or low. I'll write it here. Likelihood is low. Why? Because if you see, this business did not suffer such incident before, right? So in that case, likelihood is low. What about the impact? Impact is high. Why? Because if this lawsuit can wipe out of your net present value of 6 million, it can take away your positive net present value of 6 million, especially if someone is dead, right? And we know the huge costs of the lawsuit, right? The prices that you have to pay, especially in the case of a death. So it can completely change your positive net present value to a negative net present value. So that's why the impact is huge. So how do you now you know the impact is low, sorry, the likelihood is low, impact is high. How do you deal with this type of risk according to the box? Tell me. Take an insurance. Take an insurance. Transfer the risk. So insurance. That means you can transfer the risk. T. Okay, transfer the risk. Second one, pool closure. The loss of the several weeks revenue from pool closure for repairs and following the appearance of cracks in the infrastructure. This has occurred in several other centers in the past few years. Now tell me. Because this occurred several times means likelihood is L is high. What about the impact? See, if a pool has suddenly it has to close, okay, a new pool, this will have an high impact on the business because you are suffering on your revenues and all, right? Why? Because your newly acquired customers, they might never return to the pool. So because of this risk is serious. So now how do you deal with this? Since you know that impact and likelihood both are high. Tell. Avoid. Avoid. You have to avoid this type of risk. According to the box, this is the strategy, right? How do you avoid? Just don't build the pool until this cause is solved in other centers, right? Or maybe you have new contractors or builders, or maybe you might need new contractors or builders who can build this in a better way rather than having cracks and all those things. Third, income fraud as a result of high levels of cash receipt. So tell me, looking at high level of cash receipt means impact is high. Okay, what about the likelihood? I'm sorry, the likelihood is high. Chances of this happening is high because of but the impact is low. Why? Because this high level of cash receipts is very less in terms of volume. It's not very too much. It's less. Okay, the amount is likely to be small. So therefore, the impact is low. How do you deal with this? Reduce the risk. Reduce the risk. Reduce this type of risk. How? Maybe you can have some good internal control system over the cash handling system, right? You can prevent this risk from taking place by having a good internal control system over handling of cash. Last, loss of the playing field revenue from schools and colleges because of poor weather. Tell me. Impact is low, okay, because poor weather does not happen every now and then, and also the likelihood is low. Because playing field revenue is very small proportion from school. Schools is mostly on the student fees and all, right? That has a huge proportion. So this is less, and also the poor weather does not happen frequently. So the likelihood is also low. So in this case, just avoid this risk. That is the best, right? So now let's go to the benefit of the project. Now let us go through the project benefits, okay? This other type of benefits, and we are going to go in detail. First is strategic benefit, productivity gains, management benefit, operational benefit, functional and support benefit, intangible benefit, and emergent benefit. Starting with strategic benefit. As the word says, it is strategic. This means a new project should give you gain to competitive advantage. Okay? Maybe through business process redesign, or maybe through supply chain management, anything. Productivity gains. A project should make you more productive. That means it is making your operations more efficient than before. For example, now you are removing non-value adding activities from your process, right? By doing this, you are saving on cost also. Hence, if your strategic objective is what? Cost leadership, you can easily achieve it, right? Management benefit. Organization becomes more flexible. A project may make an organization more flexible and reactive to its environment. It might even give them more up-to-date information, right? So that managers can make more agile decisions. These benefits often arise from projects which involve organizational redesign. Remember, to make organization more flexible, this usually arises from those projects, which means you are redesigning your organization or investments in new IT system can give you that flexibility, right? Operational benefits. These benefits are seen in the areas of resources and assets, better management and utilization of these areas. For example, it might help you to simplify your job role by moving into IT system or reduce staff turnover. Functional and support benefit. Like benefits could be seen in HRM, marketing or service areas also. Intangible benefit. This is subjective, okay? It's hard to measure this. You just have to observe it, you just have to see it. For example, you can see that the benefit of the project could be to improve staff morale or customer satisfaction. Okay, remember that this benefit also goes in your business case, right? So that even if this is subjective, organization will still try to put some value to this to put it in the business case. For example, how percentage of customer satisfaction, how much it will improve because of this project, things like that. Then emergent benefit. What is emergent benefit? Emergent benefit is something which initially you didn't plan for. This benefit came out of something else. It's like a secondary benefit or unexpected benefit, you can see. Because of one benefit, you got another benefit coming out from that benefit. It just emerged. Emergent benefit. Right? It could emerge over time. For example, okay, let's see you want to change a division structure. Okay. By changing the divisional structure, it might lead to greater focus and responsibility accounting. Correct? But it can also give opportunities for further diversification. Understanding? So this benefits will come or emerge as the organization becomes more comfortable with the new structure. It is something unplanned. You didn't plan for this. That is good, but this is not always, don't always expect this. This is sometimes only it happens. So, but managers, what do? They try to manage this as well, this benefit compared to the planned benefits. Now, the scale of the benefit. See, in order to put this in the business case, you should know the scale of the benefit. You should assess this. You are going to assess this, okay, or this is going to be classified in the following scale, these benefits. Number 1, those benefits which you can observe. Number 2, those benefits that you can measure. Number 3, those that can be quantifiable, and 4th is financial. So based on this only, you will categorize your benefit. Is it observable? Is it measurable? Is it quantifiable? Is it financial? Okay. So in order to convince the management of the business case for the project, what should be your aim? Your aim should be to benefit as high up on the scale as possible. For example, if you are scoring 4, that means it's high, it's good. If you're scoring 1, it's low. Okay. Now, starting with observable benefit. Remember, this is intangible. You cannot touch it. It's subjective. You only can observe. For example, staff morale, whether your staff are satisfied or not, whether your customer is satisfied or not. Only you can observe and tell. So this benefit falls in this category. Staff morale, customer satisfaction. Okay. Next, even if these benefits are not measurable, remember, these are still included in your business case because this could be important to other stakeholders. Your customers might want to know. Your staff might want to know what is the benefit for them. Okay. Then comes measurable benefit. Measurable means it is something that could be measured, but it is not possible to estimate how much performance will improve because of these changes. At the moment, you can tell, okay, but after the project, you cannot tell what would be the impact. Okay, that is the meaning of measurable. Many strategic benefits fall in this category. For example, let's say you have a project to improve product quality, okay, which is likely to increase in market share. But it may not be possible to quantify how much that increase in market share will be. Can you tell it will increase by 10%, 20% because of the new product quality? You cannot tell. But you know it will lead to increase in market share. But you cannot put a quantity to it. You understanding? But you have to put a time scale. A time scale should be set during which you are going to measure. You understanding? Now, it is deemed too difficult or expensive to measure the increase in performance. Yes, if it is, then the benefit should be relegated to an observable benefit. See, if it's too difficult or expensive to measure that increase in performance, put it under observable benefit. Okay, because when you have to measure something, it should not be too expensive, it should not be too difficult to measure it. Then only, otherwise observable benefit. Third is quantifiable benefit. Please understand their difference. Okay, quantifiable means, now what was the measurable benefit? You could only measure at a point in time, but you will not know exactly by how much it will change. But in quantifiable, you can focus because of the changes, how much will it be? That means you can have an estimate of the impact that you can estimate before the project even starts. For measurable benefit, only after something has occurred only you can measure that. But quantifiable, you can have an estimate before the project commences also. That is the difference. Often the productivity gains and operational benefit will fall in this category. For example, okay, let's say you are estimating that new machines will produce 20% more units per hour. This is quantifiable. This is not measurable. Measurable will never be able to estimate like this until something has happened and you can say, okay, it increased by this much. The event should have happened for you to measure it. Okay. Financial, the last. This benefit can give a financial value either in terms of cost reduction or revenue increase out of the store. So the aim should be to have as many benefit as possible in this category. Why? We want the benefit to be in this category because it is objective. It is something you can give evidence for. It is something that you can bring it in terms of numbers and prove. You can put it in financial appraisal of the project also, rather than in quantifiable, measurable, or observable, where it is more like subjective. Understanding? So now let's do a question on these 4 benefits before we move on to next. Test your understanding too. Okay, so here you are supposed to consider the type of benefit included in this analysis and whether the manager's appraisal of the financial impact on the project is accurate or not. Appraisal of the financial impact. That means they have put it in as a financial benefit. Okay. Illustrate the skepticism skill. What is skepticism skill? That means you need to challenge the opinion. Okay, you need to challenge the figure that is given there. So now, in seeking to gain approval for a new project, a manager has put together the following financial assessment in a business case. Net financial benefit. You see, they have put everything as a financial benefit. Let's see. So basically your task is whether to tell whether it is correct to put that figure in the financial benefit or not, or you have to categorize it in the correct benefit, whether it is observable, measurable, quantifiable, or financial. Not all are financial benefit. Okay, this is the net benefit that they got. How did they get that? Based on this. So let's talk about extra revenue from increased market share. Is it a financial benefit? Tell me that first. Should it be included here, by the way? Is it a financial benefit? No. This is more like, you can also observable. Okay. Observable means something which is you cannot give a figure, but here you're having an extra revenue. It is something that you cannot even, it is, you cannot say it is quantifiable. You can say it is measurable because you can measure. I know it's little difficult and little tricky, but you can measure what is the extra revenue. You can measure the revenue, right? See, quantifiable means you are predicting that this will give you this percent. That is quantifiable. Measurable means you can measure that extra revenue. You're not estimating anything. So from increased market share, this is extra. So put it under measurable. It should not come under financial. Second, savings from increased staff motivation. Your ultimate thing is this staff motivation. Because of increased staff motivation, there was a saving. So this is observable. Okay, because it's very difficult to measure or quantify this, and it will not come under financial also. So this is an observable benefit. Third, savings from one staff redundancy. Tell me. Savings from one staff redundancy. What is it? From one staff redundancy only, savings. This is financial. This you can put it under financial. What about the extra revenue from 20% reduction in customer response time? What is it? This could be measurable or even quantifiable also. Right? Sometimes it's confusing. You cannot put it under one thing. So in this case, this could be either quantifiable, you can predict, or you can measure it also. What is extra revenue from 20%? You are putting a number exactly. You just didn't say reduction. You said 20% reduction in customer response. So you can either measure it or it's quantifiable. But it's hard to put a financial value to this. And total project cost will obviously come in the finance only. So if you see in finance only there are two things. One is this 15 and one is this 60. Sorry, this 75. It's a cost. So 15 minus 75, your net cost is 60,000. 60,000 is your net cost rather than 190,000 benefit. And often managers do this. They try to put everything as financial benefit so that they can get the approval of this project easily rather than showing 60. Because if you are showing a net loss cost of 60,000, it's highly possible that you are not going to get this project accepted by the board. Understood? That's the reason. So now let us go to the project cost in detail. Project cost. So in a project, these are the costs that you are going to incur. Capital investment cost, development cost, centrally allocated cost, external consultancy cost, resource cost, quality cost, flexibility cost, and disruption cost. Capital investment cost are those costs that you incur during buying hardware or IT hardware and software, right? These are project specific assets. Any project specific asset is a capital investment cost. These costs are capitalized in your statement of financial position. Second, development cost. Even these are capitalized cost. Okay. For example, historic development cost may be easier to ascertain than future development costs, which arise as the project is better understood and modifications are required. But an estimate of such costs should still be made. Remember, even if this type of cost is little difficult to estimate, you have to have an estimate of this cost. Because of this project, now you are going to have to make some modifications, or project will be now in a better way, right? Centrally allocated cost and infrastructure costs. For example, cost on user premises or central services like accounting. You need accounting, right? To take care of your accounts and all for the project, and personal services. May also include allocation of charges such as depreciation also. However, again, only those costs that are incurred exclusively for the project should be included as a project cost. If it is something that is anyway incurred, not only because of the project, you do not include it. If it is exclusively for the project, like for the project you have this accounting, for the project you are incurring these personal services, then yes, it is included as a project cost. You need a consultant who will design the project for you, who will take care of the quality, who will take care of the software. Okay, you have that. So their consultancy fee is your cost. Resource cost, this can include your ongoing staff and material cost. Okay, remember, you will include incremental cost. Okay, if you are transferring your existing staff to this project, there is no cost, okay, for the project. But if you're hiring an additional staff for this project, that is an incremental cost. Quality cost, the cost that you incurred while training your staff, in monitoring performance, reworks. Because see, project is not something that you plan and it goes as you planned. There will be so many mistakes that will happen that you have to keep reworking. You always have to train, you always have to monitor the performance, and not all the time performance will go well with the plan. So you have to rework. So this are cost that you are going to incur. You have to include it in the project cost. Flexibility cost. Project management teams need to be flexible as possible. So there are costs also. To achieve that flexibility also there are costs. For example, you are giving them, let's say, how do you facilitate flexible working? By giving IT equipment to your staff at homes, or a flexible production or servicing, such as you lower your batch sizes or depacket services. So there are costs involved in all this. To be flexible, there are costs. Then last cost is disruption cost. What is it? For example, there could be loss of productivity during project changeover. There could be anything that goes wrong. There could be loss of anything. That is disruption cost. Your electricity goes off. Your staff is injured. Right? Now, we are moving to the project plan from the business case, the next stage. But before this, let me tell you, the first three costs, that is capital investment cost, development cost, and centrally allocated cost. These are the capital cost, and the other costs are the revenue cost. Capital cost means it is charged in the statement of financial position, in the balance sheet, right? Rather than in the statement of profit and loss as an expense. You have to know this. So because of this, if you look this from the point of accounting perspective, you have to calculate depreciation or amortization, right? You have to depreciate once you capitalize it. So when you are appraising the project, whatever the method you're using, whether ARR or net present value, it will give you a different result. Understanding? Now, project initiation document. This came in the exam. I think it came in the specimen 2. I don't remember, but go back and check today whether it is in specimen 2 or not. But this came. I think 2 or 3 times this question came. So there is no doubt you have to know it. What are the contents of a project initiation document? See, a project initiation document and a business case are two separate things, okay? Do not mix the two. This comes in the planning stage after you go finish the business case. So here you should have a purpose statement. What is your purpose? What is your project drive? What is that drives you to go for this project? Second, what are your project investments, objectives, sorry. Scope statement. What is the scope of this project? How are you going to deliver this? You might even have to show the breakdown also, breakdown structure. Cost and the time estimate of this project. What are the benefit and who are the change owner? What are the chain of command? Whom you have to go and report? Team responsibilities. What is the responsibility of a team? All these things will come here. Then the project gateways, performance measures and results needs to be updated regularly. So all these things will be there in the PID. Sometimes what happens in SBL exam, I think one past paper I saw, there they gave some PID, that is project initiation document, but it was incorrect. There were things which should not be there. There should be things which are there but not in the correct order. You understanding? So you should know what are the things that goes in this content and what are the things that are not part of this content. Sometimes they might have not a very good project initiation document. Sometimes you might have to improve it also. What are the things that has to be included and all those things? That also could be a question. Okay. So make sure that you know what goes here. Now, contents of a project plan means what is your overview of the project? What are the project resources that you're going to consume? The detailed plan, the evaluation plan, how you're going to evaluate the plan, and how are you going to, what is the dissemination plan? 5 things goes in the project plan. And the exit and the sustainability plan. Every project needs to end. There should be an exit to it. It cannot keep on going forever and ever. It's not an operation of a business. So in the overview of the project, these are the things that is there. What is the background to the project? It's like a summary of your project. Okay, how it builds on previous work and the need for it, why it is important, things like that. Aims and objective. Okay, overall approach. What is your strategy? What is your methodology? How work will be structured? So in overall approach, these are the things. Important issues need to be addressed. Scope and the boundaries of the work. Also including those issues that will not be covered with this project, linked to the critical success factor. Then we still have some more in the overview of the project, that is project output. What would be the output of this project? Remember, this is a tangible deliverables. You can see it, touch it. That's why it's tangible. Including reports also, right? And also the less tangible, like knowledge that this project is going to bring, the experiences that you're going to get from this project. Project outcomes. Okay. Stakeholder analysis using Manlow's power interest matrix. You remember that matrix where we analyze the stakeholder based on that matrix? Who are the list of stakeholders who will be affected by your project, right? How their support is important. All those things. It matters. Then risk analysis based on the Tara model, right? Based on the likelihood and the impact of the risk. Standards. A list of standards that the project will use. Intellectual property rights. So all these things are covered in the overview of the project. Okay. Who will own this intellectual property created by the project? Okay. All those things. Now, project resources, the second thing. Here, it contains detail of the project partners. Who are the project partners? Okay. Including organization, reporting relation, whom you have to report, decision process, the role of any local management committee. Detailed plan will include these things, the project deliverables and reports, when they are due, the phasing of the work and any dependencies. It may also contain a Gantt chart, a diagram or a flow chart to illustrate the phasing budget. Phasing means it happens in stages, not in one go. Okay, at this stage, for example, you break down into stages, that in step 1 or stage 1 this much of work should have been completed. You see this through Gantt chart or diagram or any flow chart. There are so many diagrams to measure the completion of your project, right? Due to software and all, this is now very easy. It just breaks down your big project into stages, into chunks. Evaluation plan. This will indicate how you evaluate the quality of the project outputs and the success of the project. Okay, in this you list those factors, okay, that you plan to evaluate, questions that evaluation will answer, methods you will use, and how success will be measured. Basically, how you're measuring success. Then the dissemination plan, how the project will share their outcomes and learning with other stakeholders. Okay, so these are the things that is included. Purpose, they can share their purpose, the target audience, timing, key message. Exit and the sustainability plan. Okay, you don't have to memorize, just know this and go, keep on going ahead. That's why I'm going a little bit fast. If you can see the space that I'm going at, I'm going a little fast because you don't have, this is not a knowledge based paper. You don't have to memorize and answer these things. You just have to understand what it means, that's it, and apply it in the case study. So this plan explains what will happen to a project output at the end of the project, including your knowledge and learning. Okay, for example, how are you going to close down? Do preservation is needed? Is maintenance needed? Is any documentation needed? Right? So the sustainability plan will list any project outputs that may have potential to live on after the project ends. Why or how they might be taken forward. Any issues involved in making them sustainable in the long term. Sometimes, even if the project ends, there is still a hope or there is a way to make it sustainable in the long term. You can pull it ahead. Right? That is the sustainability plan. Third stage is project execution. So from business case to project plan, now project execution. Here we go by matrix structure. What is matrix structure? We went through the structures of organizations before, right? Organization structure, divisional, then simple structure. One is matrix structure also. This is very suitable for project management. That means you are answerable to not just one or two. You are answerable to many managers. Okay? Or you can say cross-organizational reporting lines. So the project team is likely to be made up of members drawn from a variety of different functions. This is how project team is made. You might not all be technical in one area. From different areas, people are pulled. Different functions, they are pulled together and they form a team. Okay. Each individual then has a dual role. What is their dual role? That's why it's a matrix structure. It's not just single role they have. They have role, duty to two people. They are accountable to two people. One to their divisional head, the other one as a part of the project, to the project manager. Role of the team members in the project. Remember, to execute a project, you need a team member. So what is their role in this project? Number one, team member will be having a specialist or a technical expert. Okay. So they bring technical knowledge to the team. Representative as a part of the core team. Okay. Monitor will monitor their progress against the plan. Project team members, they will monitor their progress against the plan. Then change manager. As changes are identified, it will ensure that full implications has been assessed before the changes are agreed and implemented. Problem solver. They could be a problem solver. If any problem arises during the project, they will sit down and solve it. Right? Project sponsor. See, in your SBL exam, they can ask you anything. What is the role of the project team member? What is the role of the project sponsor? What is the role of the project manager? You have to know their roles. Very important. Project sponsor. Who is a sponsor? Normally, what is a sponsor? The one who finances, right? Who helps in the finance and all. Same for project. Project sponsor is the one who sponsors, who finance the project. He's the one who gives the fund to the project. And normally, he's the senior member of the management team also. Okay. So they are often chosen as the person with the most to gain from the success. They are the one who are going to get the most out of the success of the project. And if they have to lose, they are the one who's going to lose the most. Okay. What their job is to direct the project and allow the project manager to manage the project. So these are the roles. Please, you need to know this, okay, from the exam's point of view. Gatekeeper. One role is gatekeeper. What is the meaning of gatekeeper? Choosing the right project for the business. That means those projects that suppose your business strategy, you choose those. You invest on those only. Okay. Second, sponsor and monitor. So you are going to regularly have meetings with the project leader and give them advice and guidance. You are like a guidance. Third, supporter and coach. You give practical support to the project leader. Okay. Decision maker. They can make decision also that are required outside the scope of the project. So if any decision that is required outside the scope of the project, it is the project sponsor who takes that decision on behalf of the organization. Okay. We have more roles. Champion or advocate. What does it mean? They are the one who have any type of communication with the senior managers to ensure that objectives are being achieved. Problem solver. Whenever the team faces problem or they are unable to solve among themselves, project sponsor steps in. Resource negotiator. Remember, a project success will depend on how much resources are available at the right time. So in a cross-functional projects, it is the sponsor who might give assistance in negotiating resources around the company. What resource should go here, what should go in that project is the sponsor who will decide it. Project manager is the next important person in project. His role is little different to project sponsor. He manages the day-to-day, manages the project and leads the team on day-to-day basis. Okay. So it is the responsibility of the project manager to deliver the project and ensure that it is effective and efficient across the entire project. Now their role, team leader. They are the team leader. They will build the team. They will motivate the individual. Okay. Ensure the project has a clear purpose. They plan and they coordinate in the team. Okay. Task manager. They clarify the goals of the project and ensure that every action is moving the project towards those goals. Then they communicate and their relationship manager. Remember, if there is any issue among the team, project manager comes and try to solve the issue. They communicate. Okay. And also with the stakeholders, they maintain a relationship. Problem solver. They solve the problem. They monitor, they put controls in place to ensure the project is going with the plan. Budget manager. They take care of the budget also. And meeting manager. Whenever plan has to be made or there are lots of meetings that needs to be made. Who decides this? Project manager. Okay. So all these meetings needs to be managed well. Now, remember there are some overlaps. Okay. Even though there are some overlaps, but there are differences between a project manager and a normal line manager. Please understand how. First difference is line managers are specialists. Remember, for example, you could be a finance manager, you could be an HR manager, but you're a specialist in your field. Project manager is not like that. Project manager, they need to know everything. So they are generalist. They know about everything little. They are not specialist in any field. Line manager, they work on their technical field. Project manager, they oversee many different tasks, even those that are not also which they do not have any technical expertise also about in detail. Line manager, they exercise direct supervisory authority. Directly they can supervise. Project manager, they facilitate rather than supervise team members. They facilitate. They let the team do what they want to do. So they're facilitating rather than directly supervising the team member. Now, what are the problems that our project manager could face? Number one, managing staff who are assigned to project part-time, because they might be having time in the project also their responsibility as whatever in whatever department they are, HR department, finance department, right? 2 times. So you have to manage those kind of stuff. It's difficult for manager. Second, managing the relationship with the departmental managers who have staff on the project team. Third, because I told you it's a matrix structure, managing the size of the team given the resource requirements throughout the project life cycle. You have to manage that team with the time, with the budget that is given to you, with the scope of the project, not just one or two, throughout the project life cycle. Dealing with specialists in areas where the manager is not an expert. Yes, in a team, you sometimes have to deal with those kind of people who are specialists in their area. They might be knowing more than you as a manager, because you are a specialist. Sorry, you are a generalist, right? Especially if you are not an expert in that field. Managing, how do you manage the project changes? Changes in the environment may mean that project needs to be adapted. See, whenever there is changes in the environment, you cannot blame the environment. You need to change your project. Even if you have planned the project today, that in 3 years time this is how it will go, but let's say next year only environment changes, so your project will not be viable any longer. You have to change and update your project in that way with the changes in the environment. You understanding? Second, maybe environmental changes are not there, but internal changes, for example, changes in the production techniques or resource availability, anything you have to change internally. Then also you have to change your project. The project sponsor may change one of the project constraints, such as the scope of the project. He might reduce or he might expand the scope of the project. So again, you have to change the project. Now, when changes are enforced on the project, what does the project manager do? Go back to your project initiation document and update that for the new changes. That means again resources has to be reallocated, timings has to be adjusted, project benefits again needs to be reappraised. You cannot go with the same old project initiation document. Whenever changes is there, go back and change the previous stages before going further. Okay, and project manager needs to reconsider whether their goals are still achievable or not with this new pathway. Okay, maybe you need a new business plan now that needs to be agreed with the project sponsor, especially if that new plan is totally different from your originally that you have planned. Now the problem could be treated as a slippage problem, and similar control actions could be taken, such as fast tracking or crashing the project. What is the meaning of this? Maybe you have slipped away from the project, maybe you have taken a bit longer time, or maybe, so in that way what could you do? Fast track, increase your staff and try to finish the task project as fast as possible in the due time, or crashing the project to reduce, to bring down your budget, right? Now, for changes to constraint, if there is any change, constraints means what? Whenever I say constraint means time, scope and cost. If there are changes to any of this, the project manager should consider negotiating with the sponsor again. For example, the sponsor might say now you have to make this in less time than originally was planned. You have to negotiate as a project manager. You just cannot simply accept the changes, because project does take time. Suddenly if they reduce the time, suddenly if they tell the budget we are going to reduce the budget, it's not possible that you can accept. You have to negotiate. Okay, because project manager, they often try to make changes to this, to the constraints, but it is one of the skill that project manager should resist those. Okay, now we are moving on to the fourth, that is project monitoring and control. Project control has three elements. Number one, you set the target. That's how you can control, by setting target. Second, you assess performance against these targets. You have to assess, and you have to take actions if targets are not met. That means the project is out of control. So now let's start with setting targets. Okay, performance measurements can include, okay, these things. The first is expenditure. Okay, so when you are setting target, you have to set it against cost, schedule time, okay, so that you can avoid any kind of schedule slippage from the key objective. Scope measure in terms of both product and project scope, functional quality, technical quality performance, and issue management performance. So when you're setting target, you have to include all those things. Now, the last is the client satisfaction measure. Okay, phase boundaries are a key point at which a number of aspects of the project can be reviewed. See, when you're reviewing a project, it is not that at the end of the project you are reviewing. No, this happens before you complete the project. Okay, and you set yourself some boundaries, phase boundaries, that after each boundary you will be, or after each point in the project you are going to review. Okay, you are going to review what? This question needs to be answered. That means you are reviewing these things. Is the business case for the project still valid? Is the project meeting its objective? Has the risk situation altered? Should the project progress to the next phase? So if you can answer these questions, okay, that means review stage is over. Then you are going to the next, where you are assessing the performance based on the previous 4 questions. Here, a well constructed plan. Okay, if you're having a well constructed plan, it's very easy for you to track the progress. Okay, and it is the job of the project manager. They should set up mechanisms where the team regularly reviews what task has been completed or what is delayed. Because remember, if any task has been delayed or completed also before time, it will have impact on the next phase of the project. Every phase is related to each other. Understanding? So this process is aided by, how do you assess performance? By seeing, okay, there are certain points I told you. You can call them as review points where you are going to review. Okay. And if there are any problems that you've identified, then you have to have control measure and corrective action has to be taken. Now, threat identification. When the project is not going as you planned, you have to identify those threads, because knowing them in advance can help you to come into the correct course better and faster without wasting so much of time. For example, poor management. Because of poor management also, you might not achieve, or you might there might be a delay in the project. Poor planning, lack of control mechanism, unrealistic deadlines, insufficient budget. So these are all threat identification. You have to see whether your budget is insufficient, whether you have set yourself unrealistic deadlines. In all this case, you will not be able to achieve the project as you have planned. Maybe you have planned that you are going to finish this project in 2 years time. Okay, but based on the nature of the project, it usually takes 3 to 4 years to complete that type of project. So setting a time of 2 years is unrealistic. Understanding? Moving targets. This all are threat identification. In your exam, whenever you are given a project, see whether why there is an issue, why you're not able to achieve the objective of the project. Is it because of unrealistic deadline? Is it because of insufficient budget? You have to identify. Then we are coming to the project control. Project control means you are taking corrective action. You are balancing the project effort. You are looking for where the effort can be reduced. For example, can you reduce the time? Can you reduce the resources consumed? Make changes earlier rather than late. Examples of corrective action. These things will help you. This you can write in your exam also. How you can correct a project. For example, fast tracking. What is fast tracking? Fast tracking means you are ensuring that you are able to complete the project in the shortest time possible. Maybe you are doing some activities parallelly, which you used to do in series one after the other. Rather than doing it in sequence, do the 2 activities parallelly, which saves time. For example, design and construction can be done at the same time, simultaneously. Crashing. Crashing means you are shortening the project duration. Maybe you are reducing the time taken for one of the critical project activity. Okay. Then use additional resources, add more people to that, add more time, add more money. Scope reduction, reduce the scope. Because lesser the scope is, faster you can achieve. Duration will take less. Adopting higher risk, but make sure approaches are efficient. Employee motivation. Motivate your employees so that they can perform the task in a better quality. Now, last, that is project completion. Okay, at this stage you'll be able to tell whether your project is successful or not. So a successful project management can be defined as having achieved the project objective, right? At the end, you have to achieve what objective you have set, and also you have to have benefit achieved. That is the meaning of successful project management, isn't it? Have you achieved this objective within the allocated time period? If yes, it's a successful project. Have you achieved the objective within the budget cost? If yes, it's successful. At the desired performance or specification level, yes, successful. While utilizing assigned resources efficiently and effectively, yes, successful. With customer confirmation of expectations, without disturbing the main workflow of the organization. If the answer to all this is yes, it's a successful project management. Now, reasons why projects succeed. Number one, you have project sponsorship at executive level. Number two, you have good project initiation document and business case. Strong project management, the right mix of team players, good decision making structure, good communication. I don't think I have to explain all these things. You can understand, right? Team members are working towards one common goal. If these things are present, your project will more likely to succeed. Okay. Now, reasons why a project might fail. Number one, you are failing to align the project with the organizational objective. Number two, scope is poor, unrealistic expectations, lack of executive sponsorship, lack of true project management, inability to move beyond individual conflict, internal politics, barriers to project management success. There are some barriers which will not let you achieve the success that you deserve. Why? What are the barriers? Project. The more complex your project is, the more harder it will be for you to achieve the success. Second, customer special requirements and scope changes. If this keeps changing, it's hard to be successful. Organization structure and systematic resistance. Project risk. Changes in technology. Now we are moving on to the post project review known as PPR. You have to know these terms, by the way, what it means. What is post project review? After the project is completed, we do this review. Why? Because we want to know how well a project went, so that knowledge we can use as a lesson for our later future, the project that we are going to get in the future again, right? What when good, we can apply those in the next project at one, and what went bad, we can avoid those in our next project, right? So this involves disbanding the team and trying up loose ends. At this stage, what do? If you have a team, okay, now the team is no longer a team. You disband the team, okay? Second, you do a performance review. Third, you determination of the lessons learned. You have already got your lessons from the project. What went good and what went bad. Formal closure by the steering committee. They come and they close it. Contents of a post project review. What is the content? These things will be there. For example, acceptance by the client. At this stage, this is the stage where you are going to hand over the project to your customer. The output will be handed over to the customer. Okay. Then this is an important stage to follow the dissemination plan. Okay. Second, you review the output against the goal. This is important for the evaluation plan. Okay. You should be able to convince, the project team should be able to convince that they have achieved the output against the goal. Third, you disband the team. Okay. That means you're winding up the team. This is important for exit and sustainability plan. We have more performance review. For performance review, we review the performance, right? What are the key areas that you have to review? Number one, technical performance review. Was the scope of the project achieved? Second, cost budget performance. Third, schedule performance. Project planning and control. Team relationships. Problem identification. So these are the things you have to review. And customer relationship. And in the performance review, we have more that you have to review. Communication. Risk evaluation and assessment of risk. Outstanding issues. Lessons that you have learned that You can relate to the future projects also. Okay. Remember, a starting point for any new project should be the review of the documentation of any similar project that you have taken in the past. Okay. Formal closure. So here, the project steering committee, they cannot disband until the project's outcome are seen as achieved. Once they have seen that your project outcomes are achieved, then only they will disband. Otherwise, the project is classed as unsuccessful. Okay, now we are moving on to the next, that is known as post implementation review. Remember, there are some differences. The earlier one was post project review. This is post implementation review. What is post implementation review? This is an essential component of benefit management process. This focuses on the product that is delivered by the project. Understanding? Not on the project, the product. And this usually takes place a specified time after the product has been delivered, not immediately. Then the review will not only discuss strategies for fixing or addressing identified faults, but it will also make recommendations on how to avoid this failure in the future. Okay. Without this, you cannot demonstrate that an investment in the project was worthwhile. Remember, you have to have this. To tell that investment in a project is worthwhile or not, you have to carry out post-implementation review. Now comparing the both. For most projects, post-implementation review needs to be undertaken. Okay. For a major program of change, there will be several. See, when there's a major program of change, there are several post-implementation review over the time, not just once. So this review will normally involve the project manager, senior manager, representative. Okay. They both have different objectives. They are related, but objectives are different. How? Post project review is one of exercise. That means at the end of the project, this happens one. That means you just know what are the lessons that you have learned at the end of the project, right? Which will benefit your future project. And the objective of the post implementation review is what? That you ensure the maximum benefit is obtained for the organization through the new project. And then you make recommendations if the benefits are not obtained. Remember, every project is different, right? But it is typical to perform a post implementation review 2 to 12 months after the completion of the project. The post project review, they focus on the performance of the project, whereas PIR focuses on the product of the project. Okay. A PIR, that is post implementation review, would involve the following analysis. What is it? They will see the achievement to date. Okay. Any gap analysis, they will do it. What is your achievement against the business objective? Are you with that, or are you very much behind the business case objective? If you are very much behind, that means your gap is bigger. Okay. Cost and benefit to date against the forecast. Area for further development. Consistency of the project with the overall business strategy. The effectiveness of revised business operation. That means functions, process, staff numbers, you will see all those things. Stakeholder satisfaction, both internal and external. Now, post-implementation review of an IT system. Remember, you have to have a post-implementation review of an IT system if IT system is there. For example, when addressing a new IT system, okay, let's say you want a new IT system after a changeover. What happens? You have to make a comparison between the predicted and the actual performance. That is known as variance analysis. I think you know this, right? Variance. This will include these things. Throughput speed. You will see whether the speed increased or not. Second, number of errors or queries has to be reduced. Cost of processing. You will see whether it is more or less. Amount of downtime. Okay, so the review would also need to cover whether user needs has been met or not. The review should not be performed too soon after the new system goes live. Remember, When you're doing a review, some amount of time should have passed. Because first time when you are getting used to a new IT system, because you're not very familiar, the results are very distorted. So that time you cannot do a review until you do not get familiar with the system. You understanding? So review have to be taken after some amount of time has passed, not immediately when the new system goes live. Now, recommendations should be made where appropriate to improve the system's future performance. Whenever you can see that you can improve the performance, you have to make recommendations. And the review should also make wider recommendations on improving system development and project planning and management process. So that's it for this lecture. I know this lecture is little dull and kind of, you can say, boring also, because it's like lots of reading. But the important things are, I will tell you. One is project initiation document, the contents of it. Okay, you have to see the past paper for it. What are the areas of the project management that has been asked? Knowing the cost, benefits of the project. I think these are the three important areas of a project management that you need to focus on. Okay, so we started with business case. We told the reason why business case is there because it gives a strategic reason of a project. What is the strategic reason behind having a project? You have to compare the benefits and cost in that business case. Then we talked about risk assessment. Then we went through the project plan. After business case is done, we plan the project. We provide details, schedules, resources. This becomes a part of a project initiation document. Then we execute the plans by having project teams in matrix structure. Team roles. Then how do we control the project? We set target, we assess the target at different gateways, then we take control action. Then we complete the project by doing post-project review and post-implementation review. So that's it for this lecture, and this is the last lecture in your SBL. After this, I'll be doing past paper. I think only one past paper I'll be able to do before SBL, and accordingly, with that, you will be able to do the other past papers of SBL. So now, best of luck. Wish you all the best for your SBL exam. And let me know in the comments, how did you find my SBL lecture, the SBL session, whether you find it useful, whether something needs to be added or improved or anything. Okay, thank you for watching.